to my live stream. In this stream, I am going to focus on evaluating stocks, evaluating the current trends that I'm seeing in the stock market. But I'm going to do it in a way so that investors could walk away learning something. Each stock that I look at, I'm going to go a little slower than typical just to go through each step. And I'm going to look for questions that come in the chat as I evaluate each stock. I think stock investing is a lifelong endeavor and everyone can continue to learn. I certainly learn every year how to become better and better each year. And through the decades that I've invested, I'm college educated. I got a degree in business with an emphasis in accounting, and I got an MBA. I've got a lot of industry experience as well. And I use that experience, but I would say that you can know the textbook, but applying it in real life stock investing is a skill. So you could have the knowledge, but you got to build the skill. And I think if you're a member of this community, I hope you're gathering or growing your skill set as an investor, both in evaluating what the value is of a stock, as well as your skill of buying stocks correctly, buying them at a good price, watching them go up, outperforming the market year after year, and your skill to sell stocks. I know that we tend to spend a good portion of time talking about how to buy stocks at the right time, at the right price, under the right conditions. But selling stocks might be even harder because you made a good decision on a stock. You've held it for a long time. You're sitting on a big gain. Maybe you have $100,000 gain and you really have grown attached to that stock. It may be a good idea to hold it for a long time, for 10, 20, 30 years. But it also may be a good idea to sell, or at least sell a portion of it. Establishing the skill to do that is also something you could work on as an investor. Investing is not a set it and forget it kind of strategy. It's not simple and it's not easy, but it's really worth it. If you want to grow your wealth, stock investing can help you. It's better than obviously putting your money in the bank and earning a couple percentage points per year. It's always a good idea to save money, right? It's always a good idea to save money and put money away for a rainy day, put money away, and have, some emergency money. All that's all positive. But as you maybe are starting your career, or maybe you're in the middle of your career, or maybe you're ending your career, or you're retired, we all want a better rate of return. And stocks are proven to be an asset class that when investing properly, you can achieve that higher rate of performance in the form of appreciation. The stock price goes up, pays dividends, that kind of performance. And it's a better class than bonds or savings. So that's why stock investing is something that could really help everybody grow their wealth. It's also a lot of fun. Stock investing is a lot like, playing chess or something that is difficult. It's kind of learning mathematics combined with psychology. Because as you'll see with stocks, you could definitely be right on fundamentals. You can definitely be right on valuations, but the market psychologically is in a different place. And it may be selling your stock or maybe buying a stock because it's very popular. And those things I also think we should pay attention to. So I'll comment on those as we go through this. So I've got some stocks that I could look at most definitely, but I'd like some suggestions from you guys. If you're a member of the channel, you can put those in the chat and I'll go through those stocks. We'll go through them nice and slowly, look at fundamentally what the companies look like, what they do as a business, Are they in a really desirable industry, or are they in an undesirable industry? We'll do a valuation or update an evaluation that I already have, and take a look at a stock. Hopefully in that process, you'll pick up some knowledge. You'll learn something along the way. And I'll be conscientious about the chat, because I'd like it to be, a little bit of Q&A. So put those in the chat if you'd like me to look at a stock. Overall, before I get started in looking at some stocks, you might be thinking about becoming a member. If you are, I appreciate it. If you're a returning member, I appreciate it. You don't have to be a member to attend the live stream. If you are interested, there's 4 levels, and you could, when I get into the evaluations and you see that model that I created, you could have access to that model itself. It's a working model, exactly like the one that I use. If you go with an advanced member program, you also get access to all the evaluations I put together. I keep them as a repository, and you have access to it. I put it in a share folder, and you'll be able to access it. You also get a lot of videos that are made for members, and each level has its perks. You could take a look at that on my YouTube channel. And I also put a link in the chat that you could look to becoming a member if that's something good for you. All right. So this past week was excellent. The week was really, really good. And it was coming off of a couple of weeks that were not very good. From October 28th until the end of the week prior, we were down more than 5% on the S&P. But this past week, the S&P gained a good portion of that drop just in 1 week. What took us 3 weeks to sell off a little over 5%. In 1 week, we made up well into 4.5% in the S&P. The stock market really doesn't want to sell off. And I think there's good reasons for that. There's more retail investors invested in stocks, and their participation in the market is great for them. They're going to build lifelong lessons, build their wealth, but they're also going to take advantage of some of these dips. When you see a stock come down in price, they're going to take advantage of it. Investors took advantage of Meta selling off. That dip in Meta was excellent. And you look at Meta, up 9% just this week. So if you put $10,000 in Meta, let's say the Friday, November 21st, you'd be up 9%. So you'd be at $900. And the market really telegraphed that it was selling off Meta, even though the earnings from a lot of perspectives, and I'm going to look at the stock, I'm going to show it to you on this stream because I think there's a lot of lessons in Meta. And you could have made 9% on Meta. So that was a real good winner. The other stock that's just been screaming up is Google. And Google in mid-2025 wasn't receiving a whole lot of love. The market wasn't buying into Google all that fast. It was criticizing its overall strategy, asking, or I should say, the theory was out there that maybe Google is behind OpenAI. Will it ever catch up? Is OpenAI going to disrupt the Google search business? And the answer is a resounding no. The stock is up more than 100% from the May 2025 timeframe to this point. And that is a stock that I spoke about. I've been talking about Google for the last couple of years, but especially in the April and May timeframe, I was really calling it out as the best opportunity in the big caps. And because I thought that the business was really showing the evidence that it's a great business and it's growing. It's actually growing its AI business to the point where it's going to be a great opportunity for them. And no big surprise to me, the market ended up convincing itself that, yeah, Google is really doing great. Bought into Google. Palantir had a terrific week. It's up 8.78. I'll take a look at Palantir because it is a very popular retail stock. And those that are in Palantir have made a lot of money. Good for them. That's great. Broadcom, 18.45. Phenomenal week. Micron up 14%. Incredible. We'll take a look at Broadcom and see why this stock is worth so much. Some smaller caps that have done a great job over the past week. I'm going to call out OSCR Health because it had a terrific week. It's up more than 35%. So I'll put that on the list. And we can take a look at OSCR. And we're going to look at eToro. And take a look at that small cap. That way we have a couple of small caps and we have some very well-known big caps. Now, the big caps are a great place to really understand what a great business looks like that you can invest in. And then take that lesson and apply it to other stocks. It could be a small cap. It could be a stock in another industry. So we'll get started. And I'm going to get started with Google. I think Google most definitely had a terrific week. So we can take a look at the company. And again, I'm going to go nice and slow and kind of point out why Google is such a valuable company, a valuable stock, why it has a market cap of $3.86 trillion. It's a huge market cap. I believe it's the third most valuable stock in the stock market. Year to date, this stock's up 68%. And as mentioned, it was a terrific opportunity. All the money that I invested here is worth more than 100% more at this point. And that's how we outperform the market. Buying stocks at the right time that have terrific fundamentals, that have good valuations. And when we believe that the market doesn't have it right on this stock, it doesn't have it right. It didn't have it right on Google. So investing in Google is a great idea when the terms favor me, the investor. That was the case with Google. So what makes Google so valuable? So we see that investors are willing to put $3.86 trillion of capital into this stock. That's what every share is worth. Its PE ratio is 31, and for 2026, it'll be 30. Very tiny dividend. It's really not a dividend stock. And according to analysts, the stock has gotten a little too expensive by 7%. Its price, according to analysts, 7% too high. Now, PE ratios, if a company's not growing and it's in an undesirable industry, it could have an 8 PE, a 10 PE. If it's growing a little bit, 4%, it's in a desirable industry or moderately desirable industry, you might see a PE ratio of maybe 18, 20, especially in this market where stocks are expensive. And if we have a company that is in a desirable industry and it is growing and it's very profitable, then PE ratios could be 25, 35. If they're in a strategic spot in the marketplace, 35, 45. So Google most definitely is in a high growth, very desirable space in the market because it offers good margin businesses or good margin products like search, high margin, high profitability on search, YouTube, ditto, cloud infrastructure. They make good money on cloud infrastructure. And now their AI business is really taking on OpenAI and actually leapfrogged OpenAI. Gemini 3 was really well received by the market. looking at their growth for a business their size, this is a very, very large business, $350 billion of revenue. That's huge. There's only a few companies that are bigger in overall revenue per year. Companies like Amazon are bigger, Walmart are bigger. And to grow almost 14% on such a big number is pretty astounding, very impressive. So revenue growth is it's an important line to always examine when we're looking at a stock. And I'm going to look at the quarterly, which is even better than the last full year, growing at 16%. Top line growth of a business will tell us, is that business desirable by the customer? Is it desirable by the market that it operates in? Is it getting more customers? Is it able to raise prices? The product or service is good enough where the company can raise prices. So those factors are important to consider. And revenue growth is the evidence of it either being in being a strong player in a market, having enough addressable market to be able to grow. And judging from how big the overall revenue is for Google, growing at 16% is really impressive. If the company produces close to $400 billion, in revenue per year, and they're growing by 16%, you're talking about $60 billion of additional revenue landing on the income statement. $60 billion of additional flows of revenue into the company, and that they get to make profit on and generate cash flow. So this piece here is really impressive from Google. And again, these numbers, they didn't pop up in the last couple of weeks, and that drove the stock rally on Google. You could go back to its history and see that it was putting up great numbers, but the market just didn't believe in Google. It was really predicting that Google was going to struggle. And the fact was that they were putting up numbers that actually pointed to the opposite that was occurring. They were gaining strength, gaining momentum, becoming stronger and stronger. So the top line revenue for Google is excellent. When we go into other metrics that we want to keep an eye on, does it generate a lot of free cash flow? And it absolutely does. 73.5 billion. And you can attest, what is the rate of free cash flow? They generate margin or free cash flow margin of 19%. Their profit margin is 32%. You go into some industries like aerospace and defense as an example, and they're happy with like 6% profit, 8%. Wow, that's a great year. And those are just not as desirable. They're not as desirable businesses, and they're not as desirable in industry. When you're dealing with Google or Meta or Microsoft or Apple, and you study their profitability, that's what tells you, hey, this is really desirable. This is really worth owning. And that's how Apple's become so valuable, is their profitability, their ability to generate cash flow. So we're seeing that the characteristics of a very high value company: revenue growth, profitability rate, free cash flow, yield. If you have those pieces, you could pretty much separate the really desirable businesses from the moderately desirable. And you could also point out the ones that are very undesirable. Those would be companies that don't have much profitability, can't generate much cash, and they're not growing. They might even be contracting. Those businesses are going to struggle. So that is Google. And fundamentally, on paper, it's just such a good business. On every business, it's a very good idea to study the balance sheet. And Google's balance sheet's very good. I say that because they have $98.5 billion of cash that they can do whatever they want with, but they have $44 billion of debt. So they could pay off debt immediately. It's pretty much that Google does not have debt. What we don't want is a business that has a high amount of debt, because it could have a terrific idea. Customers love the product, but it's going to sell off because it's too risky. That debt has to be paid back, and it's not worth having a stock that's risky and is going to have to focus a lot of its resources on just paying off debt. So Google has a terrific balance sheet with way more cash than debt. So the balance sheet is in good shape. So there's a lot of analysts that cover stocks. And in the case of Google or some of the big companies, you'll have a lot of opinions. And I think it's wise to use them just to see where's the marketplace putting Google. And I would say that if you looked at this in May, the analysts were saying the stock was discounted. So it wasn't a giant surprise to the analysts that Google rose so much. But the investor community is a little bit like it's a different sentiment. Analysts go through the numbers similar to what I'm doing, and they put out a price target and opinion. And the analysts had Google right. They expected the stock was going to go up. So it's good to see where these analysts are landing. It's not that I always agree with them. I would say that I always look to see what they're thinking or what they're expressing in their price targets and their reviews. And there's 42 of them. They have price targets from 355 down to 190. So on average, this stock's priced 7% too high. They all believe, well, I should say that on average, everybody's thinking it's a buy. There are some strong buys. There are some buys. The stock, you could argue, has gotten expensive because it's doubled in the last 6 months. I get that. I couldn't argue with somebody that would say a stock going up 100% in 6 months is too fast. That's a rational statement. So I couldn't argue with that. But what's good in Stock Analysis, the website, you have a section where analysts will put down what they expect will be the forecasted revenue, the forecasted profit for a stock. And down here, number of analysts that are putting in their forecast, 70 for 2026. That's a very high number. The higher the number, the better. I have more confidence if I have a high number of analysts putting their price targets out there. Then I'm feeling more confident in what I'm going to read. And it's expected that in 2026, that's a month that starts in, that's a year that's going to start in a month and a couple of days. They're going to grow by close to 13%. And they're going to keep growing by 12% in 2027, and then 13% in 2028. It's very good growth. And I think a couple of things that could make this number even better is the robo-taxi business that Google has, and of course, the AI business that it's built. I think those two can accelerate their growth. They could actually start selling into areas of the market they weren't selling before. And these areas are quite fertile. The robo-taxi, with something like that didn't exist before, but it's basically disrupting taxi service and other forms of transportation. So, and the addressable market's massive when it comes to robo-taxi. So it could really grow. In AI, that's very organic. These are new services that didn't exist before. And customers, if they get a lot of value, like I get value from Gemini, I use it quite a bit, I'm willing to pay for that. And I think there's going to be revenue in addition to everything that's being forecasted on top of that. Earnings per share growth, we want to see this grow and ideally grow faster than what we're seeing the top line grow. It looks like Google is going to take some additional expenses in 2026. Now, that doesn't concern me too much because I think they're spending more money to get that AI business off the ground. So I would be okay with that. They're spending more money putting infrastructure in that data center to support their AI business. So analysts believe the company is going to keep growing, very good data to use, and they're going to expand their profits. And you see here the PE line. The PE expected on 2026 on the previous screen was, I believe, 30. But the analysts are actually saying it's probably going to get down at the current stock price. It's going to get down to 28, 24, and then 21. And the way I like to think about it is if Google keeps doing what they're doing, which is growing, succeeding, grabbing more share of this new AI market, their PE ratio is going to stay in the 30s. But what's going to change? The stock price. The stock price is going to go up. That way, as their fundamentals improve, they get bigger as a business, more profit. You're going to see their stock price rise because they're going to deserve a high PE ratio. They're going to be a very desirable stock to the market. So Google's looking fantastic. No big surprise that over the last 6 months, the stock's just flourished. And again, if you would have bought Google back in the May timeframe, you would have more than doubled your money. And probably some of you have, and you're sitting on really good gains. Congratulations. Now, I take all that into account and I create my own valuation on a company. And I'm a believer that to really know a company, you have to study their financials. And financials of a company are produced following generally accepted accounting principles, SEC laws, and the management team of each company has to be honest and accurate for the most part, or they get in a lot of trouble, like a lot of trouble. So for the most part, the financial statements give us a true reflection of where is that business. The income statement will tell us how are they operating? Are they selling more revenue? How are their costs? The balance sheet will tell us what are their assets like cash? What are their debts? What are their liabilities? And the statement of cash flow will tell us how much cash flow are they generating from operations and how much capital are they putting back into the business. So those statements are very accurate. And I use those statements to put together a model on the company. And this model is available to advanced members and higher. If you're an advanced, super, or platinum member, you get a working copy of this model. And I think that Google is discounted by 23% because my forecast is more favorable than analysts. And I use cash flow where analysts only use earnings per share. And the cash flows I expect Google is going to produce, the net present value of those cash flows is much higher than its current stock price. So I still think Google can go higher. And I know that in the Discord for the community, some members asked, am I going to cash in on Google? And I actually said, no, I bought more shares because I think the market has acknowledged that Google is incredibly valuable, important, and the stock has rallied. I don't think the rally is going to stop. I think it's going to keep going into 2026 and probably 27 and probably 28. So I don't want to sell my stock. It's the number one most valuable position on my portfolio, probably representing 12, 13% of my portfolio. So it's a very big position. So Google is a terrific business. And that is Google. Great stock. And again, the market telegraphed, told us, this is an opportunity. And we covered that on this channel, on live streams, on member calls, on videos I produced and recorded. And you can check them out on my channel. But the stock really, really sold off for no real logical reason. The market really started to doubt Google and kept it back. Like investors weren't buying into it, thinking that OpenAI was going to basically disrupt Google. That just didn't happen. And from the low point to where it's at now, it's really rocketed up 116%. I think it's going to keep going. All right, so that is Google. Now let's talk about Meta. And again, a reminder, if there's a stock that you'd like me to look at, if you're a member, just pop it in the chat. I'll review it. If you're not a member, and you could buy a $5 super chat, and I'll review the stock that you put in the chat, and we'll go from there. So Meta is different than Google. Let's take a look at it, and I'll point out the factors that I believe make it a very desirable business. So this is not quite as big as Google. It's 1.63 trillion. It's still very big. It's a very big market cap. That means that the stock that currently trading at its current stock price is worth 1.6 trillion. The revenue, 189. The P ratio is lower than Google, 28.6, and then the forward PE is 22. So much lower than Google, much lower than most other stocks that are very, very high market caps. This might be the lowest PE ratio company out of the top 10 most valuable companies. And more recently, this stock really sold off. Over the 1 month, it's down 13.7. And and it's not worse, because if you look at, and actually when I go to this charting, it'll help me make the point that I want to make. Meta really sold off after its earnings, and it sold off, and you could have picked up shares that were discounted quite a bit. They were discounted 21.6% from the stock price that it was trading on October 28th. And that was overdone. I mean, this is a really good business, as I'll show, and it provided a really good opportunity. Those who bought shares, I bought shares, are now up 10%. So these opportunities really come up throughout the year. And this one is the most recent one on Meta. I'll go on to say that the market's done this before on Meta. In 2022, it really sold off the stock, like really sold it off by 76%. You could have bought Meta shares like $85 a share. And those who invested then in about 3 years are up 600%. And the business, for the most part, is the same business that's growing. Number one is social apps, and has terrific margins and the ability to generate cash flow. Now, looking at the fundamentals behind Meta, the P ratio is mentioned 22 for 2026. One more thing that I'll point out is when we talk about PE ratio, you're talking about the year we're operating in, 2025. Forward PE is the next year, 2026. And we're pretty close to 2026. So I'm probably going to look at this number exclusively now, because we're a month and 2 days from landing on 2026. Remember that investing, we're always looking forward. We're looking, what's the next year to 36 months look like for this company? Are they going to thrive? Are they going to keep doing great? And is the stock price going to rise? We don't want to invest looking in the rearview mirror going, well, they've done great for the last 3 years. They're probably going to do better going forward. Well, maybe, but you can't invest by just exclusively using historic data and expecting that just on that merit, it's going to continue to perform. It may, but it's only part of the analysis or part of the review. So Meta is growing at really good rates. This is a big business. It's not small, and it's growing at more than 21% if you look at the trailing 12 months. In the last quarter, it grew 26%. Now, what makes a business really attractive is its ability to profit and generate cash. Meta has terrific margins, 82% gross margins, 30.89% profit margins. So that's very high rate of profit. So it's in the category of a very desirable business for me. It generates very high free cash flow, 23.67 free cash flow margin. So those numbers look terrific. Top line revenue growth shows me that customers really like advertising on Meta. Meta has started to sell advertisements for its WhatsApp platform, and that is new. And their Reels business is really doing well. So those two things look great for the company. All right, so we have good revenue growth. We have very good profitability. Those things look great for Meta. Let's see what analysts are saying. Meta does have a terrific balance sheet. I don't need to look at it because I know Meta very well. It's the second most valuable stock in my portfolio. And analysts, 43 of them are voicing a price target for Meta, and the average discount available on Meta is 26.69. And again, at October 28th, the stock started to sell off 21%. So there was a sell-off because the market just didn't like mainly how much capital Meta was spending in the data center as they chase this AI opportunity. Looking at a forecast, 71 analysts are putting their research into this particular average forecast. So a lot of confidence. And they're supposed to grow 17.4% in 2026, 15% in 2027. Looks like I've got a question. What's the first? I'm not sure I understand your question. If you want to add more, I'll gladly respond to it. So when we look at the revenue growth, revenue is going to continue to grow. Meta is going to end up being more than $300 billion in revenue in 2028. And their profits will grow, not growing as fast as top line. I think the market didn't like that as well from their earnings. And that's because they're spending a lot of money trying to be one of the leaders in AI. So they're hiring a lot of people. Those people are expensive. They're spending a lot of, so those things are happening, and it's bringing down their profitability. So that is a yellow flag that investors reacted to, and that's why the stock sold off. It looks like what's most important. So as we look at a stock, for me, what's most important is revenue growth. If a business is growing, it shows that it's a desirable business to the market. The product services they sell are selling, very fast, maybe accelerating as people understand what they do. So my number one stock in my portfolio is Google. So that's the biggest position in my portfolio. Number 2 is Meta. Number 3 is Robinhood. Thanks for the question. All right. So this is the line that, in addition with the additional CapEx that it's spending, the drop in profitability is what was a negative in the marketplace. And that's why the stock sold off. So they could fix that. They could just pump the brakes on AI spend, continue to grow their business, and I think they're going to be all right, which is why I bought shares. I bought shares really when it sold off, because it sold off quite harshly after the 28th. I started buying shares there and have accumulated more shares in Meta over the last month. When I value Meta, I have a very good valuation for Meta. $27 discount. Their cash flows are very valuable, and their profits are going to be very valuable. As we look at this model, there's some terms that, if you're a newer investor, get really familiar with a term, or it's an acronym, NPV, net present value. And you can use ChatGPT or Gemini. What is net present value with regards to a stock? You really should understand that. If you want to be a long-term successful investor, you have to know that. It's like you want to be a basketball player, you have to know how to shoot free throws. If you don't know how to shoot free throws, you're going to be a liability on the court. You have to shoot good free throws. You need to know net present value, understand it, be able to understand why it's important. Why have investors used net present value for 150 years? Why is it a key decision criteria in investing? Free cash flow. Why is free cash flow important? You know, you could use Gemini, ChatGPT, you pick your AI platform and understand why. How many investors use free cash flow as the principal valuation method? And you'll see that a majority of long-term investors use net present value of free cash flows, future free cash flows as the valuation method. And most, and I think all successful, famous investors use it. So that's how important it is. And I built this model because I wanted to understand every arithmetic calculation, and there wasn't one available, frankly. So I created my own. Doing evaluation on a stock based on earnings per share is easier, but it's less important, which is why when I look at a valuation of a stock, I take 2/3 of the valuation from the net present value of free cash flows and 1/3 from earnings per share. So I have a blended value for each stock that fits into this particular valuation model. So Meta's been a good opportunity. I think the cat's out of the bag. A lot of investors have been buying it. And that's another stock that gave us a nice opportunity to buy into it. The market will give us opportunities, but they're not opportunities where they're going to be around, for a year. It's usually a stock will dip, it'll sell off, and you can buy. Or it might be a longer term where the market just doubts a particular company or industry. And then when the doubters kind of get proven to be wrong, then that stock flourishes for a long period of time. I'm seeing that in software stocks. I think software stocks will have a bright future. All right. So which of the three that I just talked about, Robinhood, Meta, Google, have the highest potential in 2026? Meta. All right. So we covered Google, we covered Meta. Let's talk about Palantir. Palantir has had a little bit of a rough spot, a little bit of a rough patch. If you look at Palantir, it's a terrific stock, right? It's just flourished. Really good performance. If we look at the year to date, it's kind of been, especially if you take the peak here, it's not had a very good last 2-3 months. It's been under some pressure. There's been some doubters like Michael Burry. It has responded back, but then more recently, starting November 3rd, it sold off quite a bit. So is Palantir potentially a stock to consider? In 1 second, I am going to get a chair and have a seat. 1 second. All right, so on questions, if you have a question with regards to the, I guess the methods of valuing stocks, kind of like the lessons there, pop them in the chat. If you want me to look over a stock, buy a super chat, and then I can review or comment on stocks. And I appreciate everybody being on. Or if you're a member, you can nominate a stock. Okay, so Palantir. Palantir has had a phenomenal long-term appreciation, but as mentioned, hasn't been doing all that hot for the last couple of months. So is that an opportunity? Well, let's take a look. So Palantir, if we look at its market cap, 401 billion, it's really become a pretty big market cap over really a short period of time, because they've been publicly traded for 5 years or so, maybe 6. Its revenue is a little low compared to its market cap, and its PE ratio is really high, 366 for 2025, 183 for 2026. So that looks pretty expensive. Looking at their forecast, we have 20 analysts commenting on Palantir, and on average, they think that the stock is priced fairly, just with a tiny premium. Now, the thing I also focus on is, hey, are all the analysts somewhat in agreement? They are all clustered around a particular price on a stock? And the answer from Palantir is no. You have some analysts that are pretty optimistic. Hey, the stock could be going up to 255. And you have some analysts that are bearish, concerned. Hey, this stock's only worth $50 per share. So this is something that I pay attention to, because if there's somewhat of a argument on what Palantir is worth among analysts, there's probably some sentiment out there that some investors are worried that the stock price is too high. When we look at their growth is very good, but they're growing relative to their market cap, a very small number. I just showed Meta. Meta is going to be more than 200 billion in revenue in 2026. Google Alphabet is nearing 400 billion. So this company in 2025 is 4.25 billion. That's tiny compared to those companies I just covered. So yeah, the percentage growth rate looks great, but it's a small number. And if this growth rate slows down, I think the stock's going to be under a lot of trouble. Earnings per share profitability is growing nicely, and that should lower the PE, but it's still going to be an expensive stock for the next 3 years. So the stock continues to look really expensive, and 32 analysts are putting in their research on Palantir. Palantir just has a valuation. A lot of retail investors buy into Palantir. They like the stock, and good for them. They've made a lot of money on Palantir. Over the 1 year, it's up 155. Year to date, it's up 122. I also value Palantir, and Palantir is priced way too high. And I look at the valuation based on free cash flow and earnings per share, but I only give them a 48 PE, which is what's driving down the value. And I'm just looking at their free cash flow and how I expect it to grow based on their top line growth. So those two valuations make me think the stock's really expensive. And there were analysts that were in this range of a price target, 54, and free cash flows look better, 68 price target. So this one here, Palantir for me would be a sell. It wouldn't be a stock that I would own. And I don't know that it's a controversial statement these days, because Michael Burry has his doubts about Palantir. He's actually shorted Palantir. And he's a very famous investor that has been successful on a few occasions, calling out when something's priced too high. So that is Palantir. All right. So All right, let me take a look at something other than stocks for a second. Looks like Michigan, Ohio State, huge college football game. It is a historic rivalry. And I think Ohio State, did they score? I'm trying to see an update there, but we'll see if they scored. Yeah, so I think this user, if you'd like me to look at NVIDIA, go for it. Buy a $5 super chat or become a member. I could talk about NVIDIA and we'll go from there. And thanks for joining. If you're not a member and you want to, watch, that's great. You have some questions relating to maybe a topic that I'm covering, I can answer those as well. So I still haven't gotten a score on Ohio State, Michigan. Oh, it looks like it's tied up. But the scoring from Ohio State is under review. It looked like maybe he was going to be down. Let's see what the ref's going to say, and then we'll get back to stocks. Call is overturned. So Ohio State's pretty much threatening. They're on like the 1 yard line. So, and I also see snow is dropping on Ann Arbor, and they're going to be playing in the snow. It's 4th and goal. Ohio State's on the 1 foot line. So we'll see if they get the ball in. All right. So another stock that's been flying high is Broadcom. They've done great. And Broadcom is a semiconductor stock with very good growth. They've become a $1.9 trillion market cap company. Revenues of $59.9 billion. P ratio is really high for this year, but then it's moving down to 47.8, which is still high. And analysts do believe that it's priced too high. Now, the good news that's been helping Broadcom recently is the news that Google co-developed their own AI chip to do the next phase of AI, the inference phase of AI, not building large language models, which the NVIDIA chips have a clear advantage on. But for the next phase of AI, Broadcom has been proven to be a very good option, less expensive. And it's the chip that was co-developed with Google. And it's really taken off. So Google stock is higher, Broadcom stock is higher. And I could see why. If their chips are going to be sold more often now, it makes sense. They have been growing really well, 43% for the last full year. Looking at the quarterly kind of shows less than stellar growth for the most recent quarter that closed, 22%. And the trailing 12 months growth is 28%. So this growth is not as incredible as NVIDIA growth. NVIDIA growth is incredible, like 100%. It's really, really incredible. Now, Broadcom is profitable. I believe they have terrific margins. 77%, very high profitability, 31%. Back to, these are really desirable businesses because of the kind of money they make. So it looks really, really good from these fundamentals. But the one thing I'll kind of come back to is the growth. The growth of 28%, if they can sustain that for a couple of years, yeah, they're going to be fine. But if they show any kind of sign of that growth slowing down, the stock's going to sell off. 28 analysts cover the stock, and we have some analysts that have a price target of 210, which is well below its current stock price, and the highest price target is 450. So we have a stock that is priced, according to analysts and their average, 11% too high. Now, the growth for the company, right, looking forward, they're supposed to grow better in the year that we are in, because Their year ends November 3rd, 2026. So we're already in fiscal year 2026. And they're supposed to grow at 36%. That looks pretty impressive. And they're going to grow the following year by 30 and then by 24. Earnings per share is going to grow along with that top line growth. So that looks really good. So that should bring down the PE ratio, but we have to wait till next year. We have to wait about a year and a half for it to get to the low 30s. We have to wait 2 years before it gets to 25. So I still think the PE ratio is a little expensive, but the growth is very impressive. These guys are going to announce their earnings on December 11th. And December 11th is roughly 2 weeks from 2 weeks from now. The first is Monday. So it's going to be on a Thursday if I'm thinking along the right lines. So that'll be a big earnings. I'll probably do a watch party and evaluate the stock, real time, take a look at it. So recap on Broadcom. It is a desirable business. Its top line growth looks good. Doesn't look as incredible as Nvidia. Its profitability looks great. Really good profitability, really good free cash flow. Looking at my valuation of Broadcom, and I think I'm going to adjust it a bit. So it should be a little higher growth. And I give them a PE ratio of 36. It's still, in my opinion, it's priced 31% too high. It's just too high of a stock price, and it's flourished. It's done great, but there is such a thing as a stock having too high of a stock price compared to its fundamentals, and Broadcom fits in that category. So that is Broadcom. All right, so we've covered some big caps. Now let's take a look at some small caps. So small caps are really, exciting, interesting to follow. And the first one's going to be OSCR Health, $4.75 billion market cap. We looked at Google Alphabet, that was almost 400 or 4 trillion, which is much, much larger. And these guys are smaller in market cap, smaller in revenue. And in many cases, small caps aren't quite profitable yet. So we have to forecast going forward. But as you look at small caps, you want to remember the lessons of the big caps, right? Like, what made Google really valuable? It's that top line growth. It's the ability for it to profit. Its ability to drive free cash flow. Its balance sheet. And those same guiding principles should be applied to small caps. As you look at a small cap, and it looks like Magical Self is on. Good to see you. What position size do you allocate for Uber? It's a big position that I have for Uber. Uber is one of the bigger stocks that I own. I believe it's stock number 5th biggest, but let's take a look. Yeah, Uber is number 4. So it's the 4th most valuable stock in my portfolio. It's a big position. Good to see you, Magical Self. I hope you're doing well. All right, so back to OSCR Health. So let's go over a small cap and see how, I would encourage you to look at a small cap and how you value it. All right. So the market cap 4.75. And is this business growing? Are customers liking their product and services? And the answer is yes. It's been growing really well. So they sell health insurance into a market that's very, very big. They sell insurance to individuals and small businesses. So that addressable market is huge. So they'll be able to grow for a long time. And what happened this past week is the stock really flourished because there was news that the government's likely going to help people that need health insurance. They had taken away a subsidy that people are using to get health insurance using the Affordable Care Act. And they're looking to have something that's going to help people get that health insurance they need. So if that happens, it's going to be revenues coming Oscar's way. It's going to really help the stock. So it had a terrific week. The growth is really exciting for the business. And I think one of the key metrics for a business when I get excited about it is that revenue growth, because revenue could make a business be incredibly valuable. This could be a multi-bag opportunity because of that revenue growth. So 56% last full year. Quarterly looked good on the growth. It's been a little bit of a contraction because of the taking away of the Affordable Care Act subsidies. But if they get those subsidies back, I think the growth is really going to advance. This business is already generating free cash flow, so that looks terrific. Has a very good balance sheet with more cash than debt. We have 7 analysts covering the stock, and they believe it's priced too high. It just rose 33% in 5 days, so it blew past the average price targets. But I'm willing to expect that if we get those subsidies back, a lot of these analysts are going to move their price targets higher. They're going to be believing that, hey, health insurance are going to really do better than expected. And these guys, their forecast, again, it was expected they were going to contract, but now if those subsidies come back, they're going to grow. And these numbers are going to look fantastic. So I'm glad that I believed in Oscar. I'm going to call it a small to medium-sized position in Oscar. It's not a big position. And I think it could really, really go up fast in value, as it proved over the last week. So I'm glad that I hung on to my shares and plan to hang on to them while we get through this, through the decisions that are going to be made in Washington. The best forecast I can put on Oscar show that this stock is priced really well. I think Oscar is being priced at a stock level that 49% below its real value. So I'm going to keep, I'm going to hold my shares and probably buy more shares going forward of Oscar. It's a terrific small cap that has great value, starting with its revenue growth. Its addressable market is massive, and this could really be worth a lot more in the future. Mark, good to see you. So you want to look at ESP? We can look at ESP. And I'll look at any stock. It could be a micro cap. Now, as we go down to smaller caps, the risk goes up. So when we look at a stock like Oscar, you see this discount rate. And again, if you're learning to evaluate stocks, learn net present value, what it means, and learn how discount rate comes into that formula and why it's important. The discount rate is basically, if you have a riskier stock, the discount rate goes up. In finance, we would say that that's the way you compensate the investor for the risk level. If it's a higher risk, the discount rate should go up. So this one's much higher than Meta. Meta's at 7.5. Oscar's at 11. So if everything plays out with Oscar and they do great, they keep growing, they keep expanding their margins, they keep expanding free cash flows, they get to a profitable state in their business, they're going to outperform big caps because their rate of return is going to be higher and they're discounted. So all those factors, consider that when you go to micro caps or small caps, you have to use a higher discount rate to take into account the risk level you're taking with a small cap. All right. Monty's. Yeah, it'll be uploaded later, so you can watch later. Thanks for tuning in. Thanks for the comment. All right, so I went over Oscar. We're going to go over eToro and then ESP. eToro has begun to work, which is good. When I say beginning to work, the stock's beginning to climb. And this is a new issuance. I'm careful with IPOs. This one IPO'd in May 2025 and has been sold off since. So all right. So, and I see the super chat. Thank you. Appreciate it. I'm going to get to it in 1 minute. So this one's sold off since it IPO'd. I like to give new IPOs like a year, 2 years, and then I have more financials to work with. And this one here, I am taking a chance and I started to buy shares. And so far, so good. And I think that the stock has been rising for a good reason because this is a tiny cap, 3.5 billion. And its P/E ratio is really low. It's like, wow, why is the P/E ratio so low when this company is proving that it's growing and it's going to continue to grow more modestly, but it's had very good growth. So I don't, there's something here that investors aren't familiar with eToro. I can understand there being some apprehension because it's an IPO stock. I get that. They do have good growth and they're profitable. So they have good profits. Now their profits aren't going to be like Meta and so forth because they're a brokerage. So they're making transaction fees. So that's there. When we look at what analysts are thinking for eToro, we have 12 analysts covering it, and they believe there's a big discount available on eToro. So they're seeing the fundamentals going, and this, if they could execute and come through with what they have communicated is their forecast, then they're going to be worth a lot more. And I agree with them. On average, 51.89. All right. Looking at the forecast. Now, this number isn't correct because they've already grown and they're continuing to grow. And that's the thing about IPOs is it's really hard to forecast them because they don't have a long track record of being public. But I think that eToro is worth the risk based on the fundamentals that are available and also kind of like the market conditions, right? Right now, stock investing has become more valuable than before. You have retail investors doing great this year, outperforming institutional investors, and that's not going to change. I think retail investors are using their access to great tools, access to AI, YouTube, seeing other investors on YouTube, learning to be good investors. So having said that, the economy for brokerages is going to keep getting better because more retail investors are going to come into the space. The retail investors are going to put more capital into individual stocks and crypto and things like that. And it's going to make for a very good environment for eToro, Robinhood, and others. eToro does most of its business in Europe. I like that. I own Robinhood. Robinhood's number 3 most valuable stock. and in my portfolio. And I would say that eToro sells into a different market than Robinhood. So I like that. Hey, I've got, in a way, exposure to Europe and its markets as they use eToro as a platform for their investing. So that is eToro. Now let's go over the super chat, and then we're going to go over ESP. And let's take a look. So you had Nvidia. Then you want to talk about Oracle, but I can't talk about Oracle. I work at Oracle, so I can't show you my analysis on Oracle. If you can give me a different stock, I'd be happy to review a second stock for you. In the meantime, I'm going to get into Nvidia. And so you're from Portugal. Very cool. Welcome. And Magical Self. Yeah, the rate of inflation, I don't use rate of inflation a whole lot. I use interest rates to set my discount rate. So if you have very low interest rates, the discount rate will come down because the alternatives for an investment aren't very good in bonds. For example, you wouldn't make very much in bonds because the interest rates are really low. So I would use interest rates as a main influencer into what discount rate I'm using and how high or low that would go in general. And then taking into account the risk related to a company. All right, so let's keep moving on. And again, okay, AMD, cool. So we're going to go over AMD. We went over Broadcom. We're going to go into Nvidia, AMD, and then ESP. And thank you very much, sir. And really appreciate the super chat. And I don't know that I've seen you on the streams before, but it'd be great to have you as a regular. Look forward to seeing you. All right. NVIDIA. So NVIDIA, I've known of NVIDIA for a long time. I'm a father of two sons. And my younger son, he's 21 now. He was a huge video gamer, PC based, right? So we went to esports events, and he got into Counter-Strike, and he got into a couple of games. And early on, he told me about NVIDIA because he did some Bitcoin crypto mining in 2017. We bought a couple of GPUs. So I knew about NVIDIA. I just always thought of them as a video gaming platform player. And I was wrong, because over the 5 years, these guys have taken over the data center, because companies have to have high performance computing to build these large language models. And NVIDIA is the fastest compute you can buy. It consumes a lot of power, creates a lot of heat, but it's the best, period. Nobody's even close. They've become a $4.3 trillion market cap company. Revenues, $187 billion. P ratio for 2026, 25. How is this possible? NVIDIA, PE ratio at 25. That looks way too sensible. All kidding aside, it's like, how does this company that is so important have a P ratio of 25? That looks like an opportunity. Analysts think there's an opportunity, and it's discounted by 40%. When we look at their growth is incredible, 114%. If you remember the comments I made on Broadcom, compared to NVIDIA, Broadcom's growth doesn't look all that exciting, right? This is exciting. They've become massive, and they continue to grow fast, right? So when you look at their profits, so top line growth is one of the criteria that's most important in seeing if a business is desirable. Most definitely the growth is there. But then when you look at the profitability, 70% and 53% profit margin. That is the highest profit margin we will see out of the top 20 stocks on the stock market. 53% is ridiculous in a positive light. Like, how is that possible? It's because your Their GPUs they're better than gold. They're better than anything like right now. So the demand is really high. So they can really drive up prices and get really, really good profits out of it. Free cash flow, 41%. Phenomenal. So the numbers look ridiculous in a good way for NVIDIA. I don't have to show you their balance sheet. They've got cash coming out of their ears, way more than debt. And looking at price targets, what's interesting is you have some analysts that are saying this stock can double from where it's at now. And you have some analysts that are like, hey, this stock should come down. But on average, it's discounted by 40%. 39 analysts are weighing in. So I think that the dispersion of price targets takes away from the confidence, right? It's like not everybody's in and confident behind NVIDIA. When we look at their growth, we are in the year that will end January 26th. So we're in this year. They're growing at 61. They're going to keep growing for 2 years. And then they're supposed to slow down. Maintain their revenue levels, but slow down. And their PE is going to come down to 16. I don't think so. There's just no way NVIDIA is going to go down to 16. If it's going to be in the mid-20s next year, it seems like an opportunity, especially since NVIDIA has had a pretty good pullback lately with this story that, hey, Broadcom and Google are beginning to create an alternative to NVIDIA. And now NVIDIA over the last month is down 14.5% from its peak that it achieved on the 29th. That's down 14.5%. So this pullback, and combined with even before that, for the last 4 months, it's really not done anything, right? So, okay. All right. So the year-to-date performance, 31.79, 1 year, 28. So it hasn't been flying up like Broadcom or Google. When I value the stock, and FYI, I bought shares of NVIDIA on Monday of this week because the price had come down. Right now, I think it's a fair price. I actually think they're going to do better than this. Yeah, looking at the growth and then the discount, I'm going to leave it at 7.5. Earnings per share. Let me double check my earnings per share that I've got on NVIDIA. Make sure that I'm given the latest and greatest on the most valuable stock in the stock market, which is NVIDIA. And what we're looking at from an earnings per share for the next full fiscal year is expected to be $6.73. That's what I have. Keeping it at a 36 PE. And the growth could be a little better. So, yeah, so I'm going to be buying shares of NVIDIA because there's just no way this stock is going to go down. Since, what are the stories that could help NVIDIA stock go higher, right? Well, for sure, the data center stateside demands NVIDIA GPU chips, right? That's not going to change. There's going to be demand here. Maybe the demand slows down a little bit. But internationally, as you see, other governments really take AI as a huge opportunity where, hey, we should have a large language model for, let's say, Saudi Arabia. Maybe our friends down in Brazil are like, hey, we should have an AI model for Brazil that the government basically produces, and then citizens can use that AI model. All things, for the Brazilian government. Things like commodities, farmers could use it. I mean, there's just a lot of use cases there. Australia. So all these countries, as they say, hey, we want to build out AI infrastructure because there's big value to our citizens that could be achieved. Well, that could maintain growth for NVIDIA. I think that definitely could be the case. So NVIDIA's become I would say a small opportunity for me. I don't know that I'm going to double my money on NVIDIA over the next 2-3 years, but maybe over the next 5. I think it's very rational, and it's a good pickup. So right now within semiconductor, I own ASML, TSM, Qualcomm. So this NVIDIA purchase on Monday gets me going on NVIDIA, and I'm good to buy more shares. I think it's a much better investment than Broadcom at this time. Oh, and I own Astera Labs. How could I forget about Astera Labs? This is a small cap. I've done great with it. Pretty much doubled my money in 6 months, which has been phenomenal. And having NVIDIA is a good idea for me. So that is NVIDIA. Let me take a look at the chat and see if the sponsor of this super chat had any questions on it. Man, the chat is blowing up. Thank you, everybody. We're going to hit AMD next, but let me slow down to see if there's any questions on NVIDIA coming my way. So I could cover Toast if you'd like to buy a super chat or become a member. Bo, what's up, man? You are the regular. That's not a. Are you a member yet? Let's see. Anyway, good to see you, Bo. Let's see what you got here. M&A on fire. So M&A on fire. He goes again. Can you? Don't do that. So I think you're asking to take a look at airline stocks, and I can look at Alaska, and I'm going to look at Alaska, comment on United and Delta, and kind of give you my 2 cents on airlines, and we'll get into that. Thanks, Bo. Appreciate it. Benton, you want to look at QSR, JBS? Glad to. Good to see you, Benton. Benton's a member. Appreciate you coming. You're a regular. JBS. Those are not, these are, I think, 2 new stocks to me. So appreciate it. And then Bo. So how high can NVIDIA stock go up over the next 5 to 10 years? I think NVIDIA could outperform over the next 5 to 10 years. I think when I look at NVIDIA and I think what company does it remind me of? It reminds me of Apple. And Apple came out with their iPhone. What's it? It's like in the mid 2000s, right? And the market started to pay attention to Apple, and then it just flourished, right? And it's maintained for the last 5 years. Apple has not really grown, but it's outperformed because it has such a big install space, and it continues to create new ways of creating revenue. It bought back a lot of shares. It just really managed its stock price really well. So I take my hat off to the Apple team for managing its stock really well. NVIDIA can do the same thing. NVIDIA is driving incredible amounts of free cash flow. They can go acquire some strategic businesses. They can keep growing just on their own based on their technology. And I think their growth is not done. I think they're going to grow. They might have slowdowns here or there, but I think NVIDIA is going to grow for the next 5 to 10 years. So I think NVIDIA is going to outperform over the next 5 to 10 years. And looking at where Nvidia stock is today, it's 176. So yeah, I think we could wake up to a stock price of $500 to $800 per share in 5 to 10 years. And I think, it's a phenomenal company with the best accelerated compute technology anywhere. So that's where I'm at with Nvidia. All right. So you want to go AMD or Microsoft? All right, we'll do both. So we'll go AMD, and then I'm going to do Microsoft a little later. Thanks for the super chat. All right, so not a member yet. No worries. Thanks for coming back. So Man on Fire, can you do your? God. I don't understand that. Okay, Alaska Airlines. Okay, you got it. Yeah, I've got comments on airlines. We'll go Alaska. We're still going to look at United just from a pure comparison perspective, and we'll go from there. Neil, good to see you. Due to my accountant's advices and huge losses, I've been told to pay no one even $1. Well, hopefully you start making some money on stocks. This has been a really good year, and last year was great, and the year before was great. So, focus on making some money on stocks, man. And I hope that my channel helps you. I know that I've covered some stocks that have been phenomenal successes, and I hope that some of the techniques that I'm using, I didn't think of them. I've read books, Warren Buffett's book. I've read it 30 years ago. I read Peter Lynch's books. I've read Pat Dorsey's book. That's really good. Neil, I would encourage you to read Pat Dorsey's book. He really lays it out in a very easy to understand format. And making money in 2025 was not that hard. 2024, not hard. 2023, not hard. So making money should be in everybody's return over the last 3 years. But I hope it turns around for you. All right. So at best or Apple. Yeah. I think if I look at Nvidia, and I think, what's going to do over the next 5-10 years, it's not going to be exactly what Apple did, but it's going to continue to go higher like Apple. It's good to see some doubt come into the market and start to put in some stories around, Nvidia isn't going to be as great as we thought. Okay, good. Keep the negative news coming because I want the stock price to go down. Keep the negative news coming. Because when I look at Nvidia's fundamentals, when I look at the evidence, I don't know what they're thinking, but Nvidia ain't going nowhere. And this is with the U.S. government not allowing Nvidia to sell it to China as well as other countries that the U.S. deems to be enemies or, not U.S. Allies. So if that turns around and they're able to sell into China, look out. You're going to have a nice 20 to 40% rally. So yeah, I think they're going to follow a path that Apple followed, which would be a great path. And we'll see where it goes. All right. So all right, next one is AMD, and then we're going to ESP. Then we're going to go Alaska Air. Bear with me, guys. So I think it's Antoine, and you've got CoreWeave, Nebius, MicroStrategy. I got comments on all three. If you want to buy super chats, I can cover those, or you can become a member. Both are interesting stories, and especially MicroStrategy. Which book? Pat Dorsey. So little book on investing. So let me try to bring it up. So this is all right. So obviously I don't make any money off of this recommendation. So it's a very sincere recommendation. So I've read I read the Value Investor, Benjamin Graham's book, which is like 4 inches thick. It's like, oh my God, the guy wrote it like 100 years ago. That's not an exaggeration. He wrote it 100 years ago. It's the one that Warren Buffett read. This book is this is the book I would tell my 2 sons, read this book. This book gets you in the game. If you read this book, you follow this book, you understand everything in this book, you're going to make a lot of money over the next 30 years. Okay. If you're retired and you're like, look, I just want to be comfortable. I want to do interesting things with my portfolio. And what that means is you're willing to take chances here or there. You're willing to take on a little bit of risk that makes sense. This is an excellent book. This book totally makes sense to me. Every aspect of this book. There's nothing that I disagree with. Peter Lynch, when I read the book, I was 25, 30 years younger. I was about 30 years younger. And I didn't know any different. So I read the book and thought, wow, man, this is gospel. Ooh, very cool. And over time, as I learned to be the investor I am, I don't agree with everything Peter Lynch set out and said. He had probably 10 too many general rules of thumb. And I'm like, no, don't use too many rules of thumb. This is stock investing. We're in the AI era. You don't need rules of thumb. Go get the data and make good decisions. Our friend over here, Pat Dorsey, and FYI, I set my investing approach and my overall approach to making money and succeeding before I read this book. And then I read the book and I'm like, this is exactly what I do. I don't need to be convinced that he's right. He just goes about and communicates some methods that he uses for finding great businesses. I think in a very down to earth, easy to understand way. And this guy is a killer. He was a Morningstar analyst. He was the #1 Morningstar analyst for his era. And then he's taken on, he's a hedge fund manager now. And on certain years, he killed the market. His performance was like 36, 39. He's having a bad year. He's in some stocks that I don't quite understand why he's in them, but he's in some brilliant stocks. Like he was in Meta when it was doing well. So anyway, this is the book that I would say, if you're going to read one book, read this book. If you want to invest like I do, I got tremendous amount of value from it. And he doesn't do a lot of public speaking. Look up his presentations on YouTube. They're probably going to be grainy and kind of not the best quality, but we're not watching those videos for content quality. We want to hear the guy talk because he talks to universities, like he'll talk to a finance class and so forth. And those have been recorded and they're put on YouTube. That's money all day long. Pat Dorsey. All right, cool. So this is Saturday, guys. In case you haven't noticed, I'm going to take my time when we do these analysis, okay? And I'll take all questions, especially that relate to that stock we're looking at. We just went over NVIDIA. We had a good segment on NVIDIA. Now we're going to go into AMD. AMD has had a phenomenal 2025. Part of it is really good performance. Part of it is a story, right? They're saying that GPUs are going to be a little more competitive against Nvidia. And that really drove up the stock. And those that own it have done well. The last month hasn't been great because the story that, hey, Google figured out how to create their own semiconductors that are going to handle the inferencing phase of AI. And that created a big problem for AMD, NVIDIA, which is, hey, is everybody going to still want to buy the GPUs from you? And that's kind of some of the tension that has been brought to AMD. So that's one of the stories that's brought down the stock price. But let's go ahead and look at fundamentals. This is not as big as Broadcom nor Nvidia, 354 billion. Yet AMD's been around for a long time. I'm going to say that they've been around longer than Nvidia. I'm pretty sure they've been around longer than Broadcom. They've been around, 40 years. They've been around for a while. P ratio for 2026 is 39.2. That is an expensive pre-E ratio, but let's see what kind of growth we're going to see in 2026. You see that their growth hasn't been spectacular. So here's one of the worries that I have on AMD. So all of a sudden we have AI come out in 2022, and then data centers start buying compute left and right like it's just the best thing ever. But AMD didn't jump like Nvidia's numbers just went through the roof, like 200% growth. So the market didn't really use AMD's technology a whole lot initially. Now it's beginning to use it, 35%, 30%. That's very good. But again, when I show NVIDIA numbers are incredible. Like, wow. Broadcom, good. AMD, good, but not incredible. And I would say that it's concluded that AMD is not as good as NVIDIA from a compute perspective. It's good. They're making good progress with their business, but it's not comparable. It's not a competitor to NVIDIA. When we look at their cash flow, it has been good, but one of the reasons why I really have never been an investor in AMD is they've never been a very good cash flow generating company, which has been weird because they've been around for a long time. They should generate cash flow. Broadcom generates cash flow. NVIDIA generates a lot of cash flow. And in Intel's heyday, they generated really good cash flow. You notice that their gross margins are not as high as NVIDIA or Broadcom, which shows that AMD may have a lower ceiling. Like, hey, they're not going to ever be a high profit because NVIDIa's net profit down here, profit margin is 51%. AMD's gross profit is 53%. These guys will never be as profitable as NVIDIA. So they just have a lower ceiling, much lower. And their free cash flow margin is 9.3%. So the numbers here for a semiconductor stock are not good. Okay. I'll call it like I see them. Within semiconductor, you should be doing better margins, better profit, better margin, free cash flow. And AMD doesn't have that. Now, one of the things that I would be concerned about when I look at AMD is the stock price is pricing in a lot of the good stuff that could happen in the future. Okay, well, that's risky because what if it doesn't happen? Well, the stock price is going to crash. NVIDIA, on the other hand, is like, okay, nobody doubts how great they are. It's just proven. These guys, it's like, okay, in the current year, they're growing, good. They're going to keep growing, good. And then they're going to accelerate their growth, especially with like OpenAI saying, hey, we're going to buy AMD chips. In return, we're going to own 10% of AMD. Now, I'm not in complete agreement of a vendor taking ownership of, I guess, a customer, I misspoke. a customer is saying, yeah, we'll do business with you, but you got to give us 10% of the company. Okay, that's kind of that's an awkward situation. And for investors, stock investors, that means that they're going to liquidate the company by 10%, right? Because they're going to issue out shares to OpenAI for the company. They're supposed to really expand profits, so that may happen, and it's going to drive down that PE ratio. Okay, so this stock, if they operate really well, the stock price should be okay. It's probably going to trade about the same level, maybe go up a little bit. I mean, the forecast looks terrific. Growing 37% in 2 years and then growing 39. These are really good growth rates, and the profitability is going to expand. But their profitability was lousy to begin with. So AMD, big picture, they've had some good news, and that's what's driving up the stock price. When I value AMD, I believe that the stock is priced at fair value. Okay. So if you believe in AMD story, go for it. If you don't believe, then not. I'd rather buy Nvidia. I'd rather buy TSM, ASML, because I think AMD is always going to be second fiddle, get a participation award when really the universe is owned by Nvidia. And as you see companies like Google design their own chips for the data center, I think it's going to put AMD under a lot of pressure because they could probably replicate some of the compute that AMD has, but they can't get close to Nvidia, not just yet. So that's AMD. AMD would be a sell. I'd rather be in Nvidia. I'd rather be in TSM and ASML, but Nvidia being the closest competitor to AMD. All right, so I'm seeing the chat really get active. Let's take a look here. Man, a lot of good stuff. Good to see you guys. Thank you so much. Thank you for the second super chat. Looks like 5292. Thank you. How high is Google going? All right. So I think Google is going to get to $500 a share, near $500 a share. It is discounted, as I showed. It's got a discount of 20. So we got 23% discount. My price target is 417. And you notice how I'm going above my price target. The momentum of the stock, it's going to carry it higher. So it's going to get up to intrinsic value, like the 417 I have. And it's going to keep going because the market, the excitement's in on Google. Everybody wants Google stock. Famous investors, little investors, retail investors are like, hey, man, I got to have some Google Alphabet stock. So, and I'm talking about where it's going to go in 2026, by the way. I'm not talking like 10 years or something. And I guess you wanted 1 to 5 years. So, and by the end of 2026, I think this stock could approach 500, probably go to 500. Over the next 5 years, this thing's going to 1,000 to 1,500. And you think about Google Alphabet, their businesses have a strong grasp of the future. Here's how. You have the robo-taxi business. That's future. Okay. Google Alphabet has the advantage there. Great. Cloud infrastructure. That's future. Google Alphabet has really big business. It's growing fast. Great. YouTube growing faster than any streaming platform on earth, including Netflix. It's growing faster and it's bigger. So if I think about the Google and the company we're going to have in the future, it's going to be worth over the next year or so, it's going to 500. Over the next 5 to 10 years, it's going to 1,000 to 1,500. That's the trajectory that I think it's going to follow. And I have said this for, a year and a half. Google Alphabet, I believe, is going to be the most valuable stock that is traded on the stock market. It's going to be number one. If it gets to 500, it's going to get there because it's already near 4 trillion. If it gets to 500 a share, it's going to get to 5 trillion. That could happen by the end of 26. That's my expectation. That's my research. It's only research. It's not investing advice, but I'm just giving you an answer to the question you posed. Awesome discussion today, guys. We're going deep. Yep, I'm right there with you, Bo. They've got the Google streaming stuff on TV, YouTube. They even have a quantum business. So if that thing ever becomes something, I got a front row seat. I got a front row seat for that act. I'm good with that. James, good to see you. I already made that mistake with A-Lab. Got out way too early. I hear you. I hung on to A-Lab. I did. Let me take that back. I sold enough shares of A-Lab to get back my capital, and then I'm just hanging. The rest of the shares are ride or die, man. And I think it's going to go higher. It's been having a couple good weeks. But it's cool that we found A-Lab, huh? We made some money. It's always good to make money. Yep. Google's got data centers. Google was discounted. And now everybody wants Google stock. Everybody wants Google stock. Is Google going to go down anytime soon? I don't think so. And I actually thought, like on the Discord, another investor, he's been like one of the first members, and he was looking to, was it Google? Yeah. So he asked, hey, so are you going to take any profits on Google? And it was funny because my response was, no, I actually bought shares yesterday. I bought more shares. On any kind of good day to buy shares of Google Alphabet, I'm buying shares because I think that's the stock that the major caps, that's the one that has a lot of fuel in the tank to go higher. The second one would be, I was going to say Amazon, but since Meta's been sold off, I would say both Meta and Amazon have a lot of fuel in their tanks to go higher. So I'm buying those three. That's, when you think about those three, that's about 35% of my portfolio. So I'm concentrated most on Google Alphabet. Second would be Meta, and Amazon's like, I think it was the 5th most valuable stock in my portfolio. It's still a pretty good sized position, but it's not as big as Meta. So that's, I'm concentrated on those 3 stocks, and that's my sentiment, my conviction on them. Yeah, I agree. They're knocking on the door, but I think Nvidia is going to pick up a nice rally. I love these negative stories. I make so much money on negative stories. Now the negative stories are surrounding Nvidia, and it's like wonderful. I buy when these negative stories are around, but I think the market's going to get out of this negative story mode on Nvidia soon, and it's going to rally higher. Its last earnings were phenomenal, incredible. All right, so I got to get to ESP. I think I've had somebody waiting on that one quite a bit. Sorry about that. We're having an awesome stream here on a Saturday. Taking my time on stocks. I believe that ESP is a micro cap. 114 million. Look at that. All right. So SP Manufacturing manufactures and sells electronic equipment primarily for military and industrial applications in the US and internationally. Its principal products include power supplies, power converters, filters, power transformers. A lot of power here. That's probably going to do well. The power generation, I mean, needless to say, the US needs more power. The world's going to need more power. Okay. So that looks interesting. Over the 1 year, this stock has done well. It hasn't been like going crazy. 5 year looks good. Market cap, 114. And revenue, 42.6. P ratios look pretty darn reasonable. Pays a dividend. Wow. Neat little micro cap. Fundamentals look good. No analysts just covering it because they're so small. No problem. Let's take a look at their growth. Growth has been consistent for 4 years. Quarterly, they've been contracting. Okay, this is concerning. Why are they contracting? So you have the last 2 quarters, negative growth. So they were, growing, going from 11 in the quarter, 11 for that quarter, 11, 13.6, and then they began to go down. Now they're down to 9 million. Okay. So this is concerning. Remember, this line tells me customers are not buying their product. Why not? Maybe they have to discount their product. So, okay, that one is concerning. You see how it takes a trailing 12 months and they were, humming along, growing well, and now the growth is beginning to go negative. They do have some free cash flow, $20 million in the trailing 12 months. Their product isn't as profitable as one would like because it's in a lot of ways a commodity, and it probably takes a lot of labor and materials to go into it. So it's going to have a low ceiling, although their profit margin looks really good right now. 20% is good. Free cash flow looks good. Just that top line worries me. How are they going to grow? If these guys don't grow, this stock isn't going to go anywhere. So that is the question that I would have on SB. At $20 million in free cash flow, and let me look at their balance sheet. Their balance sheet's really important. They have debt, we got problems. They don't have debt, we don't have problems. Okay. If these guys can find a way to grow, this business is worth 300 million to 500 million. If they can't grow, I don't know that it's a great investment, that's a good investment at all, because the stock's not going to be discovered. Investors will discover it if they're doing great things and they're growing and they're really becoming bigger. They might even be acquired because they're so darn tiny. But that lack of growth is what caused the stock to really come down. And that is logical. You stop growing, your stock sells off. So this one here is a sell for me. It's like, I wouldn't invest in it until I was comfortable, confident that they're going to start growing their top line revenue again. All right, let's talk a little Alaska Air. And the stocks that I have on the list: Alaska Air, QSR, JBS, and Microsoft. All right. So Mike, the dividend investor guy. Right now I'm loading up more Adobe, Meta, Uber, Google, and AMD. Nice. And heading to the gym. Sounds good. Thanks for checking in, Mike. So I don't know that I've looked at Light. If you'd like me to look at it, you can buy a super chat and I'd be happy to look at it. Let's move on to Alaska Air. So airlines. So airlines have typically had good fundamentals, but the stock prices don't really go places. They carry low PEs. They're just not appreciated by the stock market. There's probably some good reason because there is some risk out there. They have to deploy a lot of capital to buy these airplanes. And but let's take a look at Alaska. We'll look at United and Delta just from a compare perspective. This is a small cap. Now, Alaska's been around for a long time, but they've only been able to go up to a valuation of $5 billion. So that's a first signal that, man, the market doesn't pay up for airlines. It doesn't. I don't think it ever will. Revenue, $14 billion. So you are looking at a stock that is trading for about 1/3 its revenue size, which shows that the market doesn't pay up for airlines. P ratio for 2026 is supposed to drop to 9.95. Analysts think there's a big discount available. Over the 1 year, this has dropped. Over the 5 year, not good. Now, you could have picked this stock up, seen the rally go higher. I think United is going to have something similar. Now, market hasn't bought this stock, and the other peers haven't done all that great. It's not like, oh, this one company is doing great. Southwest used to be like the sought after airline stock, but they've had a lot of problems over the last couple of years, and that stock's become uninvestable. So these guys have been growing top line revenue. So they're really growing. Wow, look at that growth. Real good growth. So growth looks good. Okay. So let me go into the trailing 12 months mode. So for the trailing 12 months, Alaska Air has grown by 31%. We're going to look at their margins and their free cash flow. So free cash flow hasn't been positive for a while. That's unfortunate. I guess all that maintenance on the aircrafts, it just consumes so much darn cash. It doesn't leave cash to end up in the balance sheet, and then the company could then use that cash to buy back shares or to, acquire another business. Gross margins, 21.69, excuse me. And the gross margins have come down a bit. Okay. And then the profit margin really low. So this is what scares off investors. It's like, whoa, I'm going to own a business with fundamentals like this. No, thanks. Rather put my money in bonds, which I could understand. Let's take a look at the balance sheet. These guys typically airlines have to take out debt to buy these airplanes. Debt 6.47, cash 2.27, so $4.2 billion. Not too bad. Balance sheet's okay. It's less than 3 times EBITDA. We've got 12 analysts covering it. They're really high on Alaska. They think they're going to make some money here in 2026. It's expected that Alaska is going to keep growing top line. It's going to expand their profits quite a bit. Okay. So here's my 2 cents on Alaska, and I'm going to compare Alaska to United Airlines. I don't think it'd be very interesting to compare them to United Healthcare. So I was invested in United Airlines. Here's something that I wish I could take back. So here's United, here's Delta, here's Alaska. United has been the best airline. That's the one that I was in. And for a while, it was like, man, this United position has been underperforming. It took off. I sold my shares after a modest rise, which I was like, okay, I'm good to go. You know, I don't know where United's going to go. And I didn't take this ride up. And that was unfortunate, right? Because this whole space just flourished. And I didn't see that I was going to actually have more length to it, because I was sitting on a stock that just kept going up and down, up and down, up and down. And finally I can get out of it because the market just wasn't buying airlines. So my lesson learned is, if I were to get into another airline stock like Alaska, I would have an exit plan so that if the stock did go up, is it 25%? Is it 35%? I wouldn't get too greedy, and I would just have that exit strategy. This one here, and I would also give it a time limit. I wouldn't stick around. Like, I don't think anybody would want to stick around for 5 years and then look at their performance on a stock and go, it's down 16% over 5 years. Why did I stay that long? So if you sense that, hey, this is a good stock to invest in, either invest, have a good exit strategy, and then put a time fence. Like, I'm not going to stick in this stock for more than 9 months. I'm not going to stick in this stock for more than a year. Or buy an option. Maybe a call option on a stock like this, and see if you go a couple $1,000 and maybe you make $10,000 out of it. So that's where I'm at with airlines. I'm not in an airline right now. I'm not interested in getting in an airline right now. They're just they kind of have their own way of going up and down, and it's not based on fundamentals, because their fundamentals are very good. They're going to make money. They're going to create cash flow. If you look at United's fundamentals, the stock is discounted by like 50 to 75% at any one time, but the market doesn't pay up for it. United has been a successful stock for the last year, right? So I did pick, and I guess I should say maybe year to date's been good. No, not even. United's been better than the other guys, but it's the exception. And I did pick United as the best airline stock that I can invest in. And I guess that was proven to be correct, but I just didn't play it well enough to make a lot of money. I should have hung on longer, and I'd be sitting on United at $101 per share. Can't win them all. Lesson learned. I don't like airlines. Warren Buffett has sworn off airlines. He's like swore off on them because they burned him like in the 70s or 80s. And he swore them off. A lot of investors have sworn off airlines, and they're just too unpredictable. So that is Alaska. All right. So let me catch up on the chat here, and then we're going to go to QSR. So you're also interested in SOFI, MicroStrategy, Circle. All right. I think we have time. So SOFI, MicroStrategy. I do have some comments there. Circle. And I have comments on Circle. And Netflix. Okay. So what is Netflix up to? Yeah, I think software as a service, software companies are going to make a comeback in 2026. Totally serious about that. There's just too much value there. That's like, those are really profitable businesses. They're going to make a comeback, I think, in 2026. DT, and then ESTC. All right. Does any other industry have its own way of going up or down? Yeah, I mean, some industries just have this unpredictable, they're kind of momentum. Others that have that type of somewhat unpredictable ranges are materials, especially around companies that are going after some of these rare materials like copper and the rare earths and stuff. Those on a story, those stocks can fly up 30%. They can come down. Automotive's just in general a bad investment in my book. They just are not proven to be wealth creators, value creators. Unfortunately, right? It's an industry that we kind of, as the US, we really like our auto industry because it employs so many people. I think it's great to have automotive companies, and hopefully they continue to be good. But it's not where, like, General Motors has been around forever, and it's not one of the most valuable stocks on the stock market. Those are companies that started in the last 40 years, and they have new businesses that are real good value generators. So, all right, QSR. And mistyped the ticker. Oh, restaurant brands. Okay. So I'm not a big fan of restaurants, but let's take a look. Restaurant Brands International operates quick serve restaurants. Tim Hortons, Burger King, Popeyes, Firehouse Subs. Okay. All right. I know what that's about. 1 year up 3%, year to date 11, 5 year 23.8. So this is underperformed, right? Especially over the last 3 years. It's like, man, we can't have capital underperform like this. We got to find the right stocks. Portfolios, in my book, they have to double every 5 years. Your investments, the goal for me, for my investments, they double every 5 years or better. And that's the rate of appreciation that I need to commit to. This would be a failure over 5 years. Now, restaurants are stocks that most investors can get their heads around, can understand, because we all eat at restaurants. And some success stories like Chipotle that did really well because it was so beaten down and then it rose so nicely. But those are usually temporary kind of rallies that usually end poorly. And Chipotle has been struggling ever since. These guys are 33 billion. P ratio for 26 is going to be 18.35. They pay a dividend. They pay that dividend to attract investors. That's their little dividend trap. And they are a fairly priced company according to the analyst. We look at their growth. Growth has been good in 2024. When we look at the quarterly, growth has been good. So the growth has been good. All right. So KPIs. So Tim Hortons is growing. I want to see if they would show comparable sales, comp sales. So it's good. They grew there. So this is a well-run business. It's well-run. It may not be the most desirable business, but this one is being run very well. 16 analysts cover it. You have, and you see how the price targets go from 60 to 85. So they're, in my opinion, bunched together. So there's good confidence there that, hey, this thing is fairly priced. When you look at the price targets that are being put out there by stock analysis, they're all based on earnings per share. So as I showed you my model, that's only part of my analysis. Free cash flow separate, and they don't provide free cash flow here. So keep that in mind. These guys are supposed to keep growing. That looks good. Earnings per share is going to grow better than top line growth. It's actually going to grow real well and bring down that PE ratio. The fundamentals look good. This business looks like it's very well run, very well operated. When I look at their free cash flow, so they have $1.26 billion of free cash flow. It's a decent run business. So I'd go 15 times that number. That would get me to about 19 billion minus debt. And they have a lot of debt, 14.6 net debt. So this business would be worth like 5 billion to me. I'm not even close on their valuation. Based on cash flow, it just doesn't cash flow. It doesn't drive enough cash flow for me to value this stock up to 33 billion. You can look at earnings per share and say, yeah, I can value the stock to 33 billion. Yeah, probably, but you don't get there through cash flow, and that's more important. So this one would be a pass for me. It'd be a sell, and we'll see where it goes. It's hasn't really had a long-term rise, and I think it's a well-run business, but not a stock that I want to have in my portfolio. So JBS, update on the game. Ohio State is up 17-9 on Michigan. I see snow and sleet falling, mostly snow now. It's just a classic. Ohio State has the ball. They're number one ranked in the country. See if they can get it done in the big house. The biggest collegiate stadium, if you measure it by capacity, I believe, they can have more than 100,000 fans in that stadium. And I'm sure it's sold out today. Okay, back to stock investing. This is not Sports Center. This is stock investing. JBS USA Holdings is a packaged foods and meats producer company. It was formerly known as Swift Foods Company and changed its name to JBS USA Holdings in June 2007. Okay. So they're a foods company, meat producer. Okay. Food company. All right. So this is going to be a staple, packaged foods. Okay. 5 years. These guys are a new IPO. Yeah. They IPO June 13th, 2025. And haven't done much since then, but they haven't gone down. Seen some volatility. The stock rose up to above $16 per share, and it was as low as $12.75 or so a share. Its revenue, $13.4 billion. So these financials, why does it say 2008? Huh. Let's go to their website, see if maybe we can get some better financial data. So JBS. So here's their operation. Okay. Number one global beef producer. All right. So, okay, we're going back. Where are their financials? All right, nice imagery, guys, but where's your financials? No financials? We did that twice. So our purpose, our brands are, that's weird. You should have your financials out here, guys. Trying to see if I missed it, but so here's bond investors. Here we go. Okay, so okay, so this was released November 13th, 2025. Good growth. They grew about just a little shy of 10%. So that's good growth. And then here, again, just probably about 10% for the 9 months. That's good growth. Net sales, 13%. Looks good. So I like the growth rate. They're growing, North America, 14%. So good growth rate. Down in Brazil, they're growing by 20%. Ciara, yeah. Okay. Okay, so we got that. Now they're losing money. No, they're making money, excuse me. So profit. Okay. So they have some cash. Let's see what kind of plant, property, equipment, goodwill. So they have about $19.7 billion of debt plus another billion. So $20.7 billion of debt. Cash flows for the 9 months, they were at cash from operations 5.1 billion. We got to take away CapEx. Let's see where they have that. So we have depreciation. Okay. And then you have an increase in inventory. So they don't cash flow a whole lot. Here's their cash from operations, 1.8 billion. And they had to put 1.2 billion back into the business. So they netted about 450 million dollars of cash for the first 9 months. So if I annualized it, it'd be 600 million in free cash flow for this particular year. This business is not well known. So let's talk about 600. So stock analysis didn't fill in market cap and stuff. Let's see if I can get it from Google here. So 16.29. Okay. So I like their growth. Their debt is a little high. Their debt was like over $20 billion. So this one's way too early to invest in. Their free cash flow is only 600 million. So I like their growth. So maybe I'd multiply that times 20. That gets me to $12 billion of value for the business. And I'm not even close because I'd have to decrement the debt on the balance sheet, which is above 20 billion. So this business is like not investable to me. There's too much debt on the balance sheet to get it anywhere near a market cap where this is gives me value. So this one here, it's not an investment I'd make. If I want to get into food, I've gotten into Kroger. That's going great. It's a grocery store. And I've gotten into some staples like Procter & Gamble and Colgate Palmolive that are doing fine. So if I want good consumer staple stocks, I've got 3 that I'm invested in that I could put more capital into. So that one is JBS. All right. So Microsoft. Let me catch up here on comments. Yeah, interesting. All right, cool. All right, let's hit Microsoft. So Microsoft has had its moments of really good appreciation and then some moments of concern. Like here was the great appreciation coming out of the tariff induced sell-off. It was flourishing. Also coming out of 22, it really performed great. But it's had its moments like, hey, it really sold off here. Middle of 24 up until April of 25. And now it's beginning to kind of show some of some lackluster appreciation. It's down 8.15 over the last 5 months, 6 months. So what's going on with Microsoft? How come the market's not bidding this stock up? Year to date, it's up 16.71. I think that's outperforming the S&P just by a little. but it's not outperforming its peers that are the biggest, most valuable stocks like Nvidia, Google, Alphabet. I think it's outperforming Apple, but it's underperforming some of its big peers. And Microsoft is a really good business. I mean, it's like been around forever and has products that are just integrated in the way people work. Now, we have a market cap of 3.66 trillion, revenues 293. Google's bigger than they are from a revenue standpoint. P ratio going into next year, 29.6. Oh, interesting. I know that they're growing, so that's why it's like, wow, I mean, this is an opportunity. Price target, analysts think it's discounted. They have been growing nicely. It's a big company, growing nicely. Look at the quarter. The growth has actually gotten better. 18.4. That's big growth. That is excellent growth. Trailing 12 months looks good. Let's look at their free cash flow. And free cash flow is 78 billion. They have good profitability, 35.7. Very good free cash flow margin, 26.5. So these numbers are excellent. Excellent numbers. Forecast, 33 analysts are putting a price target out there. And I feel like the price targets are bunched together from 500 to 700 per share. Everybody's above its current stock price. So the whole lack of enthusiasm from Microsoft has suppressed the stock price. Is it an opportunity to get into Microsoft? Is it a good time to buy this business? Because Google Alphabet was the best buy of the big caps in 2025, but that stock's already bid up. Is Microsoft now the most desirable one based on its valuation, right? All right, so I could probably increase this guy. Should be higher. 15. Yeah, that'd be good. Let me double check earnings per share. The earnings per share for 20, and they have a fiscal year that ends in the middle of the year. So their year that's going to end June 30th, 2026, it's supposed to be $15.95. It's growing nicely. I think Microsoft's a good investment. I think you're going to do well with Microsoft. And right now, Google Alphabet's priced far higher than it was 6 months ago. So it's not a bad idea. I don't know that you're going to outperform the S&P by a whole lot, but Microsoft is a smart investment. It's a good investment to make. It's a good company. I prefer to buy Google Alphabet, Amazon, and Meta ahead of Microsoft. I'm not going to be buying any shares of Microsoft, but feel that the stock is priced quite attractively right now. It would be a positive add to my portfolio because it's discounted. But right now I want to concentrate my capital on the 3 companies I named that are near the top of the most valuable stocks in the stock market. And Nvidia. I mentioned Nvidia. I'd rather own Nvidia because I already own Google Alphabet. And Google Alphabet and Microsoft I view as very similar companies. Now, Nvidia is very different, and it's on the top of the food chain for AI. It's not a bad buy right now, so I'm going to buy more Nvidia instead of a company like Microsoft. So that is Microsoft. All right, good stuff. So let me check the chat. Good to see you, Michael Anthony. Thanks for joining. Okay, cool. So let me get the next one ready, and then I'm going to take a 5-minute break. So we're going to go over SOFI, and we go over SOFI. It's a pretty popular stock. It keeps coming back. I keep analyzing it. And the good news is it's been a real good winner for people. I don't own SOFI, but I could start off here when we come back. I am going to come back in 5 minutes. I'm going to go take a break, and I'll join you in about 5 minutes. Everybody hang tight. We're going to come back and pick up on SOFI. Thanks for your patience. And if you want to put comments in the chat of stocks you want to look at, if you're a member, just pop them in there. If you're not, $5 super chat, and we're off to the races. I will be back. All right, so I am back. Let's pick up where I left off. SOFI is the next stock. See if I missed any important comments on the chat. Looks like Benton, you might be interested in TLN. Yeah, we can look at TLN. Not familiar with that one, but here's the stocks that we have in our path. SOFI, MicroStrategy, which turned into a micro tragedy over the last couple months. Circle, Netflix, DT, ESTC, which might be Elastic, and then TLN. Keep them coming. It is Saturday. I've got the football game going on in the background. Let's keep looking at some stocks, see what is going on with SOFI first. SOFI is $35.8 billion market cap. This stock really performed this year. 5-year, it's kind of a two tails in one. The stock really flourished back in 21. Stocks crashed. This one took its time to come back, but boy, did it ever come back. Investors were really nicely rewarded who took the chance on SOFI back here. You went up 4-5 times your investment. Congratulations if you did that. The PE ratio on SOFI is at 54 and 53 for 2026. That is a little expensive. Analysts think it's gotten too expensive. It's priced 17% too high. When we look at their growth has been good. They've become a $2.6 billion revenue company, and their revenue is 27.8. So here we've got growth is looking great in the quarter, 37.8. Very good growth. And this, I think this stock here sold off on news, and I thought the news was good. But the market, that was kind of a good thing that the market started to sell off stocks, even though the earnings were good, showing that, hey, if stock prices are too high, they're going to sell off just because they're too expensive. That's good. We shouldn't have overly expensive stocks and they just keep going higher. That could artificially create bubbles, and then we have really bad stock conditions for 5-10 years if we don't watch it. So these guys are classified somewhat as a bank, and I'm going to view them as a bank. With banks, I don't look at cash flow. I look at PE ratios and book value. And SOFI has been expanding their book value. So the book value per share has gone up nicely. It used to be negative, and it's gone up to $5.96 book value per share. There's another ratio you want to look at, which is price to book ratio 4.08. So these like historic banks like JP Morgan's at 2.7, Citi is under 1. You want this number to be as low as possible. And SOFI is high. Now, part of the reason is they're a growth stock. So yeah, they're going to have a high price to book ratio. They're more expensive because they're a growth stock. Okay. I'm willing to go along with that. If they stop growing, the stock's going to really go down because its price to book is really a poor ratio. Analysts think that this, and there is an argument that the dispersion among price targets from $12 to 37. So they're not like all somewhat agreeing around a particular price target. So the stock has gotten a little expensive. And looking at 2026, they're going to keep growing. The growth looks good for 26 and 27. The profits are going to expand nicely. And a lot of analysts are putting their research into these numbers. The PE continues to operate in the mid 30s, which is expensive. It's not a really well-known name. And in this industry, they don't make a whole lot of money. I have a valuation on SOFI, and it is updated because I updated it after their earnings. Again, I thought their earnings were decent, but I think the stock price has gotten 31% too high compared to its true value based on profits. So it would be a sell for me. And it really has risen a lot, and it just became too expensive. That is SOFI. So let's go to MicroStrategy, or I guess it's strategy now. Look at that stock chart. Whoa. Whew. For a while, investors were feeling like, man, it was a genius move to get into this stock. But holy smokes, the last 6 months have been quite a rough ride, because investors, just looking at July 16th, 2025, they just took a hit. Now, last time I checked, Bitcoin had recovered quite a bit. Now, what strategy was doing was they were taking out debt intended, and that money was intended to buy Bitcoin, and they'd have a Bitcoin treasury. So looking at, and let me compare it to the Bitcoin. That'll be interesting, because I actually was thinking of maybe buying strategy instead of Bitcoin, because so strategy is pretty much you're buying a leveraged position in Bitcoin. So it's going to have greater volatility. Now, on the way up, and maybe that doesn't show it here. This is better. On the way up, strategy was really flying high. It was outperforming Bitcoin like crazy. But now it's back. It's back to underperforming the Bitcoin. Are we to a point where maybe buying into strategy might be a good idea? I don't know. I own Bitcoin. I've done great with Bitcoin. Not going to sell my Bitcoin. And strategy is going to be tethered to the price of Bitcoin. And now I don't know that investors are going to be all that excited about buying into strategy, because once bitten, twice shy, right? The last 6 months have been rough. And right now the Bitcoin is at $90,000 per coin. And at one point it was 124,000. And that was like 6 months ago. So I don't think MicroStrategy is going to make it to my portfolio. It's just too risky. I already own Bitcoin. Right now, if you ever wanted to buy into Bitcoin, now isn't a bad idea. Like, now's not a bad time. If you wanted to be a Bitcoin owner, Bitcoin is a alternative asset class. It's a hedge. I bought it in 2017, 2018. I've ridden it up to where it's at today. I've sold a little bit along the way. I'm pretty much done. Would I buy more Bitcoin? Maybe, but probably not. Probably not for at least the next 6 months. I'm good with my Bitcoin portfolio, and I'm good. So MicroStrategy, I can't value using free cash flows and so forth, because there's not enough free cash flows. And it doesn't really do an earnings per share, because it's really a treasury. You're buying a levered Bitcoin treasury, way out there, super high risk, but at certain times, investors have been killing it, but now the investors themselves are being killed. So MicroStrategy, under pressure. Bitcoin is faltering, and so is MicroStrategy, or strategy stock. Now, a new player on the scene is Circle within crypto. And Circle does stable coins. Now they came out and a very popular stock. Guess I could stay here. They IPO'd recently, right? So, yep, they IPO'd earlier this year, and they had a really nice rally after they IPO'd. I mean, it really rallied hard. But everybody who jumped in kind of wish they hadn't. It's down 69%. This is a stable coin issuer. Stable coins are interesting to see how they're going to function, if they're going to be a big success or not. But I just don't see a lot of money in them. The way that Circle is going to issue out coins, buy the position in treasuries that would then back or provide the holding behind the stable coin. Interesting. Okay, cool. But I just don't see a lot of money to be made there. So I'm not in the space. I'm not invested in it. I'm invested in Coinbase, and I'm good with Coinbase. I like what Coinbase is doing. Coinbase is creating new products. They are in partnership with Circle. They make money when Circle makes money. And so far, yeah, you could have taken a wild ride with Circle, ended up, back to where Coinbase is at. But maybe I can go over the 6 month. Yeah, if you bought exactly 6 months ago, Circle would have taken you on a wild ride. You would have been so happy for a while, and then kind of gotten killed over time. So I'm going to stay with Coinbase. It's doing positive over the last 6 months. Coinbase is up year to date. And I've done well with Coinbase overall. It's all about, when you buy a stock. If you buy when I don't like IPOs. Coinbase IPO'd. It was the first publicly traded crypto company. And going from here, IPO date, let's see if this will work for me. You really got killed, right? Going from IPO date into 2023. But really, if you started accumulating here, you are doing great, which is my position. Like, I started buying when I knew more information about Coinbase. I understood the big story that they're trying to accomplish. And overall, for the last 3 years, it's been a real good stock. So I'm good with Coinbase in my portfolio. And I don't think Circle is a good investment for me. Netflix. What's Netflix been doing? So Netflix is year to date up 20.69, 1 year up 21, 5 year up 118. Now this one here, back in 2022, the market was really silly, thinking, man, we got to sell off Netflix by 73%. And those who thought, man, this is a great opportunity to buy, rode a really nice appreciation curve. I did that. I bought Netflix, and I ended up selling it around this point. So I didn't ride the whole upward, chart, but I took a big gain, cashed it in, moved on. So I did buy it around this time. What's going on with their fundamentals recently? They continue to grow, but I think their stock price has gotten too high. It's gotten to be a $455 billion company. One of the things is that this is like a single product company. They do streaming. That's it. They don't do anything else. So when times are good, great. You guys are going to do fine. Their growth for 2024 was good. Let's look at the quarterly. 17% growth. That's very good. The trailing 12 months, 15.4. Good. That's a very good growth rate. When we look at their gross profits, 48%. Not quite as good as like Meta. Meta has 85% gross margins, and the profit margin is 24. It's a very good profit margin. Free cash flow, good, 20.67. So these are good numbers. Just the valuation of the stock, it's gotten to the stock price has gotten too high. Because when I look at Netflix and I look at the value that I can calculate based on their free cash flows and their profits, it is lower than it's. All right, so something's wrong here. So here's Netflix. Do I have two Netflix out there? Netflix. One of one. Okay, here it is. Oh, did they do a stock split? Yeah. And I think my shares outstanding is not current. Okay, that's what happened. All right, so all right, so there we are. So there's a stock split, and the earnings per share needs to be adjusted because that's the old earnings per share. So Netflix is a good example of, you know, buying at the right time, selling, making money, and then maybe I'll make money again on Netflix at some point. So now the earnings per share is going to be $3.30, growing by about 15. That's fine. So right now I think Netflix is 14% too high. I already took the gain on it. We'll see where it goes. The last month with Netflix, where has it been? It's under a little bit of pressure, not too bad, but I don't think it's going to perform all that well in 2026. And what Netflix is doing now is they used to, in their earnings, is show their compare against YouTube, but YouTube is doing way better than Netflix. YouTube is bigger in overall revenues, and it's growing faster. So Netflix will never catch YouTube if the same holds, right? If Netflix cannot grow faster, it's always going to lag YouTube. So YouTube's going to be just bigger, more powerful, to get more advertising on it, all that good stuff. And a lot of people subscribe to YouTube through YouTube TV, or you go ad free on your regular YouTube account. So Netflix has already achieved its valuation. You can see that there is pressure on the stock. So hasn't done nothing for the last 6 months. So I'm okay that I sold the stock. I think investors are thinking twice before investing in Netflix going forward. I don't think it's going to perform well next year. We need the stock to come down maybe to $80 a share, and then I'd be interested in buying it at around $80 a share. Somebody asked about DT. That's Dynatrace. All right, so Dynatrace. Before I do that, let me see what question this is. Okay. All right, so Dynatrace, what do these guys do? So Dynatrace engages in the advancement of observability for digital businesses, which transforms the complexity of modern digital ecosystems in North America, Europe, Middle East, East Africa. So an AI-powered observability platform. Seems like a good idea. Okay. And what's the stock been doing? So it's been around for a while. The 1 year it's down. And they may have changed their description to say, oh, well, we want people to think we're an AI company, because they've been around for a while. They were probably trying to brand themselves as a cyber company, cybersecurity, and have recently said, well, I think we want to call ourselves an AI company now. The 1 year doesn't look good. 13.43 billion is their market cap. PE ratio is mid-20s, and analysts do think it's discounted. They're growing 18% for the last full year, growing nicely. Not the biggest company we're going to come across, but that's a good growth rate, 18.5. And they have very good gross margins, very good profit margins. So these numbers look terrific. Okay. Now these guys are being kind of put into the software space. The software space is not been catching a lot of investing, and they've actually been selling off. So it looks like this one is experiencing the same thing. The fundamentals look great. Good growth, great profit, very good cash flow. 475 being their full trailing 12 months cash flow. And I imagine their balance sheet's going to be in very good condition. They have way more cash than debt, way more, over $1 billion. So these guys are probably going to price at a discount, but right now, I mean, I can show you 25 software stocks that are discounted based on their valuation metrics. And this one here is probably going to be discounted as well. Here's Dynatrace, discounted by 39%. Now, it's not enough to find it at a discount. When is the software space going to catch a bid? I don't know. It's hard to say. We'll see if we can see a rally start. If it does, I'm already in some software stocks. I'll probably add to those stocks and probably want to maybe find another couple. But there's plenty of deals in the software space. Dynatrace is discounted, but when will the market start buying software stocks again? We'll see. I think it's going to happen in the next 6 months. We should see a rally going because those fundamentals can't be ignored forever. So that is Dynatrace. ESTC, I think that might be Elastic. Yeah, and these guys are, so Elastic, a search artificial intelligence company, provides software platforms to run in hybrid public and private clouds. Okay. So this is a software application technology. Okay. 1 year down. So software stocks not receiving a whole lot of love. We're going to go through the same thing we just went over DT on Elastic. This is a $7.4 billion market cap. Forward P looks good. This is 2026's number, discounted. Growing. Fundamentals are probably really good because it's a software company. High gross margins. They're small, so they haven't made it to a profitable state yet, and they generate free cash flow. So these guys are going to be discounted. Analysts think it's discounted by 52%. I think I might have Elastic on here. So let's see. ESTC. There's Elastic, discounted. So when will software stocks catch a bid? I'll be ready because it's going to move a lot of stocks. And we'll see if maybe a couple of stocks truly are going to be disrupted by AI. I don't think that's going to be the case. I think a lot of these stocks or a lot of these companies that provide software, the software is really helpful to businesses. So why would they stop using it? So TLN, Talen Energy Corporation, independent power producer, infrastructure company, produces and sells electricity capacity and auxiliary services into wholesale power markets in the U.S. These guys are doing great because they are selling their power to data centers. Wow. And it was a small cap. It's really gone up in market cap. Its revenues at $2.34 billion. P ratio 22.24. Strong buy, but only a small discount. All right. So why isn't revenue growing? Okay. Now it's growing. Okay. The growth is here, but look at all this negativity here. Wow. So the stock was going up a lot, even though it had a revenue decrease in 2024, it still went up in stock price because the market believes these guys are going to just be worth more because they sell power. All right, let's see how profitable this business is. So their profit margin, 9.65, not very profitable. And their free cash flow. So these guys are just making the deals. It looks like they're a broker-like business and they probably own long-term contracts and they can sell that power to other people. Well, good for them. But I think they have a ceiling. It's not like they can buy power from others all that easily anymore. So I think this one's going to crash down at some point because it's gotten too overheated. So their free cash flow, assuming they can sustain it or grow it, is $226 million. So let's say I took that number and I went times 20. It would get me up to about $4.5 billion. Do they have any debt? They do. $3 billion. 2.5 billion. So they're not a very good investment because if I take their free cash flow, which is 220 million, multiply it times 20, it's going to get me to about 4.5 billion. But then I need a decrement 2.5. So I get down to $2 billion of true market cap value. They're way up at 18. So the way I would price this company way back here is where they should be priced. And they can only sell the power that they've contracted for. So it's not like Nvidia, hey, we'll just make more GPUs and sell more. No, you can't. It's a limited resource that you have. So you're not going to be able to grow anymore. But the story has been exciting for them. So I think this one's going to really, really go down at some point because I don't see how they're going to continue to grow. I guess they could charge more money for the power. So the story is intact, but that's all it is. It's a story. The fundamentals do not support the stock price. And I invest on fundamentals. I don't invest just strictly on a story. All right. We covered 19 stocks, everybody, on this stream. Thank you so much for joining. Appreciate it. Looks like I've caught up on everybody's comment and all the members who requested it or the super chats that sponsored some reviews. Thank you, everybody. All right. So I think it's a good place to stop. I might stream again tomorrow if you guys are up for it. Look for that notice. And for sure, I'm going to stream on Monday, 9 a.m. Eastern, and I'm going to stream with Daryl. I'll do the fundamental analysis, and then Daryl will do the technical analysis so we can cover stocks from two different perspectives. And if you can join, that'd be great to have you. And this coming week is going to be the first full week of December, and we'll see how December is going to perform. It's expected that we're going to have a rate cut now in December. And that's what's creating some of the enthusiasm that, hey, stock prices are probably going to go up because we're going to have lower interest rates. And I can understand that. Yeah, I can understand that. So we'll see if they cut interest rates by 25 basis points or 50. And then from there, we'll move into 2026. I think we've set up for some industries like software to really perform well. I think healthcare is going to continue to perform well. And it's a matter of buying stocks when they're really good stocks to buy, buying them at great prices, and then figuring out how to outperform the market in 2026. So that'll be the agenda for the month of December, is how to be positioned to do well at the beginning of 2026 and then continue to adjust to stay on top and keep advancing the value of a portfolio. All right, so that is it. Everybody have a terrific rest of your weekend. Thanks for tuning in and participating in the live stream. It's a good session, and appreciate you guys. You guys take care.